Hello, everyone, and welcome to this first Best Investment Opportunities Summit. First and foremost, we hope that you and your families are all well, and we would like to send our support to all those people who are directly suffering the negative impacts of this pandemic. Throughout history, after any great crisis, humanity has gotten up and gotten back on the track of growth. And it is precisely at such times that the best investment opportunities arise. And yet, often investors who are burdened by the negative emotional impacts we're all suffering now decide to leave the market and miss out to a large extent on the significant returns that can be captured long term right now. And this often happens because investors feel alone, they have nowhere to turn, and they are influenced by these emotional negative forces that we're all experiencing. And that's why from Finect we think it's very important to hold this event, an international event, which is 100% online, in which we're going to have speakers who will be with us from California, New York, Copenhagen, Paris, or London. And we want to basically achieve three goals. The first is to give greater visibility to the investment strategies of the best managers out there. Secondly, to bring investors and managers closer so that investors can have very solid information and arguments in order to counterbalance those emotional forces we're all experiencing right now. And thirdly, to convey very valuable information to all financial advisors so that they can help their clients to select winning trends and avoid investment errors. Thank you very much for following this live. And I also would like to thank all the fund managers who are going to be participating, representing some of the best firms out there, including Fidelity, Franklin Templeton, M&G, Morgan Stanley, Nordea, HF, and Schroders. Thank you very much to all of them and for supporting us in this event in which we want to bring the best investment strategies to both investors and advisors. And this is the beginning of BIOS 2020. Hello everyone, how are you? We hope that you're all well. We're going to begin right away with our first speaker, but first, we want this event to be very interactive. We want you to experience it from home, on your phones, on your tablets, on your computers, as if you were right here chatting face-to-face to the managers. So I'm going to give a couple of recommendations so you can live it that way. First, browser and key in www.finect.com/BIOS. BIOS, caps, as you can see back here, finect.com/BIOS. And there's a web app. You don't have to download anything, so it's all very simple. And you can use it to send in your questions and comments. You will see a small space where you can key in your questions and comments, but also participate in the surveys that we will be launching to get feedback from you about what you're thinking of what the managers are sharing with you. And one more thing, hashtag BIOS 2020, hashtag BIOS 2020, which you can use on social media, on Twitter, LinkedIn, whatever you want, in order to share your views, your ideas about what you're hearing on BIOS. So let's now test this web app I just mentioned, this system for your participation. So please open on your browser a new tab with www.finect.com/BIOS 2020. And you will see a small survey, which I'm going to launch in a minute. And so first, we're just going to test it out with a very easy question. And we're going to ask you, what are you planning to do this holiday? This is just for you to get familiar with the web app. And the choices that you will have to answer are, you'll be able to vote in a second. The choices are stay home, which is very comfortable, particularly if you have air conditioning. Go to the beach is number 2. Go to the countryside, number 3. Go to a camping site or a mountain cabin, or go abroad. So let's vote on these choices so you can get used to this tool. And the countdown starts now.
Vale, ahí está, empezamos una cuenta atrás.
Okay, so that's the countdown. You have 10 seconds to vote, to make your choice. You know, it was stay home, go to the beach, go to the country, and so on. Camping, mountain cabin, or go abroad. Well, with all the current uncertainty, of course, getting on a flight is not easy, but there are adventurous people who are willing to try it. But remember also, while I get the results of the survey, and before I read them out, I'd like to remind you, those of you who are EPAC members, that tomorrow at the end of this seminar, there will be a link so you can fill in a test and get your credits for your recertification. Okay, so the answer here, the most popular answer is go to the beach. I suppose you're all looking for a tan and a dip. That's great. And now let's move to a slightly more serious question before we start the first presentation. Let me just read out the question, give you the choices, and go through the same process. Again, finet.com/bios, and there you will be able to find how to send in your questions and ask questions and comments from the managers, our speakers today. Second question, which would be your favorite geography for investing right now? And so would it be the US, the Eurozone, the UK, Asia, or LATAM? So these are the 5 choices, and the countdown starts now. Okay, so there's the countdown with the wonderful BIOS logo. And now let's see whether you want to pick the US, the Eurozone, which actually was lagging behind, but has started to rally in the markets quite a lot in the last few weeks. Or would you prefer the UK after Brexit? There's also been a lot of companies with very attractive valuations, according to some managers, or Asia or LATAM. So let's see. We're receiving your votes. Almost 42 votes already have come in for this question. Okay. And we are almost finished with your results. So your favorite investment area right now. And so, as you can see on the screens, your choice, your favorite choice is Asia with 40% of the answers. It would be your favorite geography to invest in right now. The US, close second runner, and behind the Eurozone. And interestingly, no one's picked the UK or LATAM, so your choices are clear. All right, well, thank you very much for taking part. Keep participating through this web app. You can send your questions and also on social media with the hashtag BIOS2020. Okay, so let's get started with our first speaker today. We're going to listen to someone from Fidelity. At Fidelity, we have been creating value for our clients for over 50 years. Their trust is present in the over 410 billion under management all over the world. We create opportunities through our own team of analysts, our independence, innovation, client-centered. We work every day to continue to build trust and value. So we're going to start BIOS 2020 in London, close to St. Paul's Cathedral, and we're going to hear from John Guiness, who's portfolio manager at Fidelity International. He is a great believer in the opportunities in connectivity and seeks out the best names to take advantage of this trend. He's as passionate about this as he is about Arsenal. Whenever he can, he goes to the Emirates Stadium to watch his team. Thank you, John, and you go ahead and open this BIOS 2020.
Fantastic. Thank you very much indeed for having me. Thank you to everybody at Finet and everybody watching the video cast. I'm here to tell you about why I'm so excited about future connectivity. So if you turn the slide to slide 2, why invest in future connectivity? Why think about it now? Well, point 1, we believe that consumer and business activities are moving from offline to online and from online to mobile. This is a long duration and material trend. Number 2, This is leading to innovation and disruption across multiple industries with clear winners and losers. The fund exploits this theme with a deep understanding of the underlying technologies, the new business models, and takes a truly global perspective. We believe that the future connectivity universe benefits from stronger growth than the broader investment market, and that the stocks we think about and invest in benefit from even better growth still. Turning over to page 3. So connectivity is a basic human need. You can see here the history of connectivity from the very start, cave paintings and smoke signals and carrier pigeons, all the way to today with Zoom and Snapchat and TikTok and Fortnite. Humans have been connecting to each other for millennia. Turning over to slide 4. We all know that connectivity plays a key role in our lives. We all know that we spend probably too much time on our mobile phones, too much time watching video, and playing games and doing e-commerce, etc. But it's an integral part of everybody's existence. Turning to slide 5, we believe that we are now in a golden age of connectivity. There are 3 reasons for this. Number 1, the speeds at which we are all able to connect are increasing exponentially. Here on the left is a slide from Cisco, and it shows incredibly fast speeds available from 5G. In the middle, the data intensity, the amount of data that are going over our networks, is also growing exponentially, and so are the number of people connected, shown in the chart on the right. So we are in a golden age. Moving over to slide 6. What does this mean? Well, at the top of the pyramid, you can see connectivity is getting faster and much cheaper. This is leading to what Satya Nadella, the CEO of Microsoft, called the rate of the digitization of people, places, and things. And we believe the impact of this digitization will be felt in every sector of the economy, from mobile payments in finance to e-commerce in consumer, to telehealth in healthcare, to Internet of Things in the industry. And within this, that means there are many, many incredible investment opportunities. Now, turning to slide 7. Connectivity economics break global barriers. The global scale of what we are seeing at the moment is unparalleled in human history. On the left-hand side, you can see the number of the billions of people who have connectivity to the cloud, which is around 5 billion, have access to social media, which is 4 billion. The same number have smartphones, and around 2 billion have access to e-commerce and m-commerce. This means there's an incredible virtuous sustainable circle where the enormous global platforms like Amazon, like Netflix, support unprecedented connectivity. This leads to lower customer acquisition costs and high incremental margins. These global winners always have a better product than the local competition, which leads to higher consumer loyalty. This is what we've seen with people like Amazon and Netflix. Now, turning to slide 8. Now, we think about these trends every day, but actually, if you look at the numbers, most categories are very early in the transition. So this slide shows the penetration of online groceries, online dating, restaurant food delivery, car sharing, streaming video, mobile commerce, and mobile gaming and social. Most of these are very, very early in their adoption curve, which is why we're so excited. And slide 9 shows that the digital economy is one of the biggest drivers of GDP growth. On the left-hand side, you can see the digital economy real value added for the US economy, and you can see that every year the digital economy far outstrips the rest of the economy. And on the right-hand side, you can see that 5G will have a significant positive impact on the economy too. Now, how do we think about the addressable universe of connectivity? Well, we have 3 pillars. Number 1, we call the enablers. The enablers are the companies that make the equipment and devices that power the superfast networks. These are companies like Apple, who make the phones, Ericsson, and Murata, who help make the chips in Japan. Secondly, the networks. These are the owners of the connectivity infrastructure. These are companies like Telefonica, like Orange, like Vodafone. And in the fund, we own companies like Verizon, Charter, and Cellnex, the mobile tower company based in Europe. And finally, we have the innovators. Now, these are the companies taking advantage of the shift from offline to online and online to mobile, and include companies like Google, Alibaba, Tencent, and Facebook. Why are we so excited? Well, on slide 11, you can see the enablers revenue growth. There's two really exciting things about this chart. Number one, we believe the 5G supercycle will happen whatever happens to the economy. So whether we're in a recession or we're growing fast, telecoms operators are investing in 5G, and Apple will launch their 5G phone. Secondly, we're excited because the 5G cycle is going to be bigger than the previous two, and we are right at the start of it. Turning to slide 12, the networks are a little more steady and they have regular revenue growth. Within this, there are pockets of high growth, and we'd outline Cellnex, who are consolidating the European tower market, as a great example of this. Then turning to the revenue of the innovators, you can see in this slide that the innovators benefit from huge structural growth. Why is this? This is the shift from offline to online and online to mobile, and then it's the revenue of all the companies who are benefiting from the digitization of people, places, and things. Now, turning over to slide 14, our process is very clear. We look within each of the pillars, so within the enablers, within the networks, and within the innovators, and we work out what are the key trends within the theme. And then, having worked out what the key trends are, we work out who the winners are and also who the losers are. So here I'd highlight the 5G investment cycle. Who do we think will win this? Well, we think Apple will be a key beneficiary of this with the launch of the iPhone. Thinking about gaming going digital, we own Sony in the fund. Thinking about on-demand digital entertainment, Spotify is a big stock in the fund. Now, I thought I should cover a few of the trends we look at in a little bit more detail. On slide 15, you can see one of the trends in focus, which we call music going digital. Now, on the left-hand side, you can see the most amazing chart. This chart shows the history of the US music industry from 1973 to now. Why is this so interesting? Well, you can see the innovation caused by the compact disc, the CD, which was launched in about 1985, led to huge structural revenue growth. And the music industry was a very fast-growing industry. But in 2000, that stopped. Why? Because the technology changed. People started downloading music and stealing music using Napster, but the technology had changed. But now, what is happening is very exciting. You can see there's very fast growth in the music industry because companies like Apple Music, Spotify, and Amazon Music have changed the way that people consume music. It's moved to subscriptions, and the growth you've seen in the number of music subscribers has been very impressive, which is why we own Spotify in the fund. Turning the page to slide 16, another trend in focus, gaming goes digital and mobile. On the left-hand side, you can see the incredible growth that the mobile gaming has had and will continue to have. On the right-hand side, you can see some data from Ubisoft, the French computer game maker. They believe that the number of global gamers will expand from 2 billion in 2019 to 5 billion gamers over the next 10 years. An enormous increase in gaming driven by mobile, streaming, free-to-play and subscription, and Asian gaming. So again, in the fund, we have a lot of stocks on this. We own Sony, we own Tencent, we own Activision, and Take-Two as we play this trend. Now, I think the final theme and focus is advertising video on demand. And this is a very exciting theme because we believe that not many other investors are thinking about this, but it's a very exciting opportunity. We all know what video on demand is. That is people like Netflix and Amazon Prime Video. Advertising video on demand is when you introduce targeted adverts into this internet delivered video. On the left-hand side, you can see estimates for global advertising video on demand market revenues. But on the right-hand side is the really exciting thing. When you watch normal television and you see an advert, they are not targeting it at you. They do not know who you are. They do not know whether you have a family. I have a 2-year-old son. I buy lots of Pampers, nappies for him. They do not know anything about me. But when you have advertising video on demand, it's a targeted advert. And so the amount that advertisers will pay for that impression, for that view, on the right-hand side is many times higher. Now, the final 2 slides from the presentation. This slide is just the performance of the fund. And I guess there's 2 takeaways from this, 2 broader takeaways. Firstly is we're very lucky to have had relatively decent performance. And I guess that's been very gratifying that even during the crisis, the performance of the theme has done very well. Why is this? Well, firstly, the process of going from the trend, working out who the winners and losers are, and then focusing on the stock. That has been a key focus for us. But secondly, and more broadly, we believe that the theme of global connectivity, of content moving offline to online and online to mobile is a very powerful theme that is very big and will last a long time. And so we believe that investing behind that theme, for example, with future connectivity, is a great way to think about it. And then the last slide, slide 19, why think about future connectivity now? Well, we believe that the COVID-19 crisis has accelerated our key investment themes. On the left-hand side, you can see the use of video conferencing and Teams, but you can see that even after China went back, use of these products kept accelerating. And on the right-hand side, you can see the acceleration of the existing structural trends like digital publishing, social media, education technology, video streaming and gaming, all of these themes that are growing anyway because of everything moving from offline to online and online to mobile. These have been accelerated by the crisis. So that's my presentation. We're very excited about the theme, as you can see. I'm going to stop talking now and hand it over to questions.
Muchas gracias, John.
Thank you very much, John. Thank you so much, John, for that presentation, for your time. There's actually several questions that have come in, but let me just remind you that you can send in questions and you can actually vote on other users' questions on finec.com/bios caps, and there you can see where you can key in your questions and also vote on other users' questions so they get picked. So, John, let me just start with a few of these questions, and the first that I'm going to ask says, is such a desirable sector with such high valuations, how do you distinguish between the hype and the actual real quality and solid value in the future?
So that's a fantastic question, and it's something that we think about all the time. So I guess I would say, I'd say 3 things. Firstly is, my background is a Bain & Company. I was a consultant, so I really understand the business models. My colleague, my co-manager who runs the fund, Sumant, he is a technologist. He used to work for Intel and Altera, designing chips. He was in the team that designed the first graphics chip for the iPhone. So he really understands the technology, which is amazing for the team. And finally, we have a fantastic Fidelity investment global team. So they really help us understand what's happening. But secondly, I would say we do a lot of due diligence. We speak to a lot of experts. We meet companies all the time. We have our ear to the ground, so we know what's going on. We go to Silicon Valley the whole time. But finally, we do not pay very, very high multiples for companies. So we believe that companies like Google, even Amazon on the enterprise value to sales, these are not too expensive for us. But some companies, I would say Zoom, like Shopify, where you're paying 20, 30, 40 times sales for a company, that's too high for us. So we would step away when it comes to the unbelievably high, I would call insane valuations.
John,
And John, we have another question which says, how have you been investing during this COVID-19 crisis? And what changes have you made in your allocations, in your portfolios during these months?
Good stuff. So when we think about the crisis, we think about two types of company. The first we call the lockdown winners. And these are companies like Amazon, as we're at home buying more products online. It's like Activision or Sony. Lots of the teenagers are gaming more when they're stuck at home. Companies like Spotify, there are lots of companies in the fund who have benefited from the crisis, as I showed in my last slide. So these are the lockdown winners. But also, as we emerge from the crisis, there are lots of companies where the valuations are currently very low that we have been buying. So companies like Booking.com, which benefits from travel coming back. We believe that will be a relative winner as it emerges on the other side of the crisis. We've been doing a lot of work on Amadeus IT, the Spanish company, which helps airlines. We believe they might be a winner. So coming into the crisis, we owned a lot of the winners. But now, as we hopefully emerge the other side of the crisis, we've been shifting the fund a little bit into the companies we think will win as the crisis ends.
And I have another. What are the differential elements between your Fidelity Communications Fund and the Fidelity Global Technology Fund? And what could the inclusion of the fund contribute to an equity portfolio?
Great. So the reason we think about the investable universe in terms of the enablers, the networks, and the innovators is because the connectivity theme impacts all of the sectors in the economy. In the technology fund, it's got amazing performance, and that's focused on the tech companies, which are broadly the enablers. We invested in the enablers, but also in the connectivity infrastructure companies like Cellnex, for example, who benefit from these super fast networks. But also we're invested in the innovators across the economy, not just in media, not just in internet, but also in other areas of the economy who benefit from super connectivity speeds. So I guess one fund is very focused on the technology side of things and has amazing numbers, but we're focused a bit more broadly on the positive impact that connectivity will have across the wider economy.
And how resilient do you think is this 5G technology cycle that's just beginning?
We believe it's very resilient. So in one of the first slides, I showed the different speeds, the 3G, 4G and 5G speeds. We believe that when the 5G networks are rolled out to the full and you have a very high density of the towers, that 5G speeds will be very, very fast. So, for example, my home broadband is 100 meg, which is very fast for home broadband in the UK, probably not Spain. But we believe that 5G speeds will be 100, 200, 300 meg. So, for example, you'll be able to download an entire movie, a whole film onto your phone in about 4 or 5 seconds when 5G is spread out across the economy and is at its fullest potential. So we believe that this is transformational and that there are lots of innovative use cases that we haven't even thought of yet, which will emerge as 5G is rolled out.
Okay, we have one more question, and we're practically out of time. That says, which new areas are you exploring? You've already mentioned some of the areas you are exploring, but for the future, what other areas are you considering as interesting to invest in?
Great stuff. So these are 2 areas that we haven't invested in yet, but we're doing a lot of work. So one of the areas is telehealth, and so that's everything from talking to your doctor through video conferencing. It's having the wearable, having your watch taking all your vital signs in your body. It's aggregating the data together, etc. That's one area, telehealth, and the other area is online education. And online education is very interesting because no company has really done extremely well in it yet, but it's definitely a clear trend. And so we believe that there'll be emerging winners and losers. And so it's an area we're doing a lot of work in, and it's very exciting stuff.
Para terminar, John.
And finally, John, you know that we like to stay on top of the news, and we've been seeing that whole Whitecast scandal lately and those big fluctuations. Do you think that cases like these can be an obstacle to the optimism surrounding the technology sector and the fintechs?
So, the Wirecard scandal, you mean?
Sí.
Yeah. So definitely. I mean, it's luckily at Fidelity we didn't own any, and we were shorting it. It was nothing to do with me. I don't look at Wirecard, but it's I'd like to think it's a one-off case. I think if you look at Wirecard, the Financial Times and lots of journalists and some hedge funds, a lot of people knew that there were issues around Wirecard from a long time ago, since 2017, 2018. So I think that's a one-off case where it took a bit of time for people to realize it was a fraud. But I would like to think that it's a one-off case and there are no more Wirecards in Europe. I think it's probably a unique situation.
Okay, well, thank you very much, John. Thank you very much for your time and for taking part in this first BIOS 2020 and for contributing your investment strategy. Thank you very much. I hope you'll have a really pleasant afternoon. Thank you.
Thank you for listening.
Nada, ha sido un placer. Vamos a pasar ahora.
It was a pleasure. So now you have to use your mobiles or click on your browser's tag because we want to hear from you. What's your feedback? What do you think about this investment idea? What do you think about John's ideas? We'll start with one question. So what's your take on this investment idea? How attractive do you think it is? And I'll give you some time to vote. So, how attractive did you find this investment idea presented by John Guiness? You can choose from 1 to 5, 1 to 5 stars. You can vote now.
A la votación. Los resultados no.
We won't be sharing the results now, but we'll tell you about the most successful investment ideas later. So 5 is the top score and 1 the lowest. So thank you very much for your participation and also to improve things and to share your feedback with fund managers. Please score John Guiness' presentation and you can vote now. From 1 to 5. So thank you very much for your input and feedback. So now, without further ado, let's move on to the next presentation from Schroder's managers.
Nos quedamos de nuevo cerca del Támesis.
So we are still close to the River Thames. Isabella Hervey-Bathurst will be sharing her views with us. Investments for a more sustainable world was one of her priorities. That's why she joined the 2018 Marches for the Planet. She also enjoys nature. So we're looking forward to hearing from you, Isabella, to get to know your vision.
Hello, good afternoon. I hope you can all hear me. I've got about 20 minutes just to talk you through climate change investing, which is what I work on. I work on the Schroder's Global Climate Change Fund. I'm the co-manager of the fund along with Simon Webber. And I want to talk you through a bit of background around climate change investing, a little bit on how we approach climate change investing, and then finish up with why we think this is such an exciting time to be looking at climate change investing. So the fund was launched in 2007. So this was long before climate change investing became a sort of fashionable topic, because we were convinced early on that mitigating climate change would have a very profound impact on the growth of the global economy. So the science is clear. Addressing climate change will impact almost every sector, and it'll start to impact their revenues, their cost structures, their balance sheets, and their valuations. And the market typically isn't very good at forecasting and pricing in these non-financial risks. And that creates a really exciting opportunity for active investors. We invest across 5 key investment themes. You can see them there at the bottom of the slide, and I'll come on to those later. But first, I just want to take a step back and to set the scene and to outline the scale of the challenge and the scale of the change that's needed. So back in 2015, global leaders came together in Paris, and they agreed to put their national economies on a path that would be consistent with no more than 2 degrees of warming relative to a pre-industrial baseline. And the 2-degree level was chosen because that's the level at which the consequences of climate change are thought to be manageable. And once we go too far above that level, those consequences are thought to be uncontrollable, with very damaging implications for both people and the planet. So as you can see on this slide here, even at 2 degrees, the consequences aren't entirely benign, but once you get up to 4 degrees, the consequences are pretty disastrous. So that's why the 2-degree level is so important. So how are we getting along in terms of getting to that 2-degree level? This is the Schroder's Climate Dashboard. It's a tool that's been developed by the sustainability team at Schroder's. And what it does is it looks at 12 different metrics across 4 categories: political ambition, business and finance, technology solutions, and entrenched industry. And it compares what we should be doing if we're to be on the 2-degree path versus what we are actually doing today. So, for example, if you look in the bottom right-hand corner, you can see that the rate at which we're currently producing fossil fuels is consistent with a 5.9-degree temperature increase. On the slightly more positive side, the rate at which we're currently building renewables is consistent with a 2.5 degree scenario. So that's getting closer to the 2 degree desired target. But in aggregate, this dashboard is indicating that we are on a path to a 3.9 degree temperature increase. So I think we can take this 3.9 degree number in a couple of ways. I think at face value, it's a fairly depressing number because we know just how damaging it is once you go above the 2 degree level. But what it also tells us is that if we are to get to 2 degrees, the pace and the scale of change from here will have to be very rapid indeed. So what would it take to get to that 2 degree level? Well, what it requires is an 80% reduction in greenhouse gas emissions per capita by 2050. And those emissions must eventually go to zero. So clearly this is not just about building a few more wind and solar farms at the margin. It's a really radical transformation of the structure of the global economy. And in terms of the implications for investors, we think this means that we will see $2 trillion per annum flowing into the companies providing the solutions to climate change over the next 10 years. And then on the flip side, we see 15% of the value of global equity markets as being at risk. So the kind of things we're talking about there are stranded assets, companies whose business models are rendered unviable by rising carbon prices, and companies whose products and services simply get regulated out of existence. So this topic matters hugely, not just for people who are interested in the opportunities from climate change investing, but for global equity investors more broadly. So having briefly touched on the risks from this theme, I want to now focus on the opportunities. These are the 5 key themes I mentioned earlier, the 5 key themes that we look at, and they are clean energy. So as you would expect, this is renewable energy and the infrastructure that enables it. Energy efficiency. So this is companies whose products and services help other companies become more efficient in their use of energy. Environmental resources is the 3rd theme. So if we think about the world over the next few decades, things like water scarcity are going to become an increasingly difficult issue to deal with. And we're also going to have to address the fact that we massively overuse the Earth's resources. So we have to get much more circular in our use of the Earth's resources. And there are companies playing into those trends within the environmental resources theme. Our next theme is low carbon leader. This theme is, I think, pretty unique to this strategy, and it's a pretty interesting one. And what we are looking for here are companies who are essentially reimagining existing business models, but in a lower carbon way. So to give you an example of one of the kinds of companies you'd find in there, we have been really interested in companies which provide low carbon, in fact, zero carbon data centers. So on the face of it, those companies have nothing to do with climate change. All they're doing is selling space in their data center. But what they are enabling is other companies, corporates like the one I work for, to outsource their computing power to a zero carbon provider. So that's the kind of thing that's in low carbon leaders. And then finally, sustainable transport, which is, of course, electric vehicles, electric trucks, trains, and other forms of mass transport that are lower emission than the ways we have today. So how do we go about the process of trying to identify the winners and losers from this theme? One of the things we spend a lot of time thinking about and we take very seriously is the construction of our investment universe. We start with the global investment universe, and the first thing we do is we apply a screen, and we screen out any companies which have significant fossil fuel reserves or revenues. And then from then on, it's all about positive inclusion. So we're actively thinking about what the 2-degree world will look like. What are the companies that can enable that transition and flourish in that world? And if we're convinced that those companies will be beneficiaries of that transition, then we can put them into our universe. And the universe has about 600 stocks at the moment in it, and all of them fall into those 5 key themes that I mentioned earlier. Now, at this point, I think it's important to point out that we haven't made any decisions about the valuations of these companies. We haven't made a judgment about whether or not they're good investments. We're just looking for which companies are positively exposed to climate change. So the investment process we follow is actually a kind of fairly traditional one. We follow a growth gap philosophy. So we're looking for growth that hasn't been anticipated by the market. And we also apply a fundamental risk framework. And I think with a strategy like this, a careful consideration of risk is really important because we invest across the market cap spectrum. And within our investment universe, we will have companies that are very big and diversified, and also companies that are small and may only have one key product or service. And so taking risk into account is obviously incredibly important. So with this strategy, obviously environmental factors are at the forefront, but we also take into account the social and governance factors as well. And we end up with a portfolio of about 40 to 70 companies. It's 66 at the moment. And we're active owners, not just in terms of meeting management teams, but also in terms of voting and engaging as well. So over the last few minutes, I just want to talk about why this is such an exciting theme now. Now, we often hear, or we increasingly hear, governments and companies committing to be net zero by 2050. And that's fantastic. But what it can lead us to feel is that 2050 is rather a long time away. And is this trend really going to be impacting companies today? And we see really strong evidence that it is already having a big impact in certain areas. So taking clean energy, for example, renewables are now the cheapest form of new energy in 2/3 of the world because their costs have just fallen so much over the last decade, and in fact, 3 decades. So they've really reached an interesting inflection point where they are cheaper than fossil fuels in more than 2/3 of the world. And we're actually not far off another inflection point, which will happen when building new renewables will be cheaper than running existing coal or gas. And that will be another catalyst for this market. But at the moment, we're really excited about this market just because it's become so economic. It can stand on its own 2 feet, doesn't really need subsidies anymore. And if we are to decarbonize the thermal generation mix, we need to be building renewables much faster. We're probably only building about half as much renewables every year that we need to if we are to fully decarbonize power generation. So we're really excited for the growth in renewables, and not just the sort of end renewables that you think about, but also the whole value chain, the infrastructure that supports it, the cables, the utilities that own and operate. Within the solar space, it's not just panels, but it's inverters. So there's a whole ecosystem around renewables that should see really exciting growth over the coming years. Another area that we think has reached a really interesting inflection point is in the auto sector. So if you look at the chart on the right, you can see that between 2011 and 2017, there were really only 2 electric vehicles on the market which had a decent enough range on the y-axis, a decent enough range to overcome range anxiety, which was a key barrier to EV adoption. And both of these cars were Teslas. So they were premium vehicles. Not everybody can afford a Tesla. But if you fast forward to where we are in 2020, we're in the midst of a whole range of product launches from a whole different number of OEMs. And these products are coming with good ranges, and crucially, they are several of them are at mass market prices. So the product offering within the EV space is materially improving at the moment. And we are seeing the EV sales grow rapidly from a very low base. So we're excited about the auto market as well. And again, it's not just thinking about, a Tesla, but it's also thinking about who makes the cathodes that go into the batteries, who makes the batteries, who makes the chips that go into, the semiconductor materials that go into the car, that sort of thing. So there's a whole range of different investment opportunities up and down the value chain. It's not always just, the obvious one at the end. But if we are to decarbonize the economy, we have a lot further to go. And these trends have really only just started. Decarbonizing power generation and electric vehicle and internal combustion engine vehicles, in a way, they are the easy piece of the pie, because we see exactly what we need to do. We just need to do it a little bit faster. This chart shows a carbon abatement cost curve. What it's essentially showing is the carbon price you would need to decarbonize various sectors of the economy. And at the end, there is a whole range of things which are not abatable at current technologies. So what this tells us is that we need to rapidly scale up existing and new technologies in order to tackle this problem. And we also need to see higher carbon prices. And if we are to get to net zero, as so many countries have pledged to do, all of this will have to happen within the next few decades. And one of these areas that is probably more at the frontier of addressing climate change and hasn't had as much attention is food production. And I think this is partly because it seems less obvious than, say, a power plant, but also it seems more intractable, more difficult to address. And thinking about agriculture, currently agriculture is about 14% of greenhouse gas emissions globally. And under a business as usual scenario, by 2050, agriculture will use up the entire carbon budget. So as it's unrealistic to expect every other sector to go to zero, it's clear that something has to change with agriculture. And probably that means dietary habits and patterns will have to change. Which leads us on to alternative protein. So on this slide, you can see that the different sort of environmental footprints of different types of foods. So in general, animal-based foods have a worse emissions profile than plant-based foods. And the single animal-based food product that has the worst emissions profile of all is beef. And that's the one. It's probably quite small on your screen, so I apologize for that, but it's the one right at the top. But there are some interesting innovations coming to the food industry. And one of them is alternative protein or plant-based protein. So there are companies today, companies like Beyond Meat or Impossible Foods, who are trying to isolate components from the plant world to recreate the taste and texture of meat. And they're actively trying to target people who eat meat rather than targeting just vegetarians. And these products have had a very good reception so far. And crucially, their environmental impact is much, much lower than your traditional beef burger. So for example, a Beyond Burger has 99% less, uses 99% less water than a beef burger, uses 93% less land, produces 90% fewer greenhouse gas emissions, and uses 99% less energy. And this market is just 1% of the global meat market today. And to do a little thought experiment, if we think that this market could perhaps take the same share as plant-based milks took within the dairy market, then this market could be a $140 billion market in 10 years from less than 14 billion today. So we're quite excited about these new areas that are emerging in the sort of harder to abate sectors. One thing we haven't yet mentioned is, of course, COVID-19. And I think before I wrap up, I just want to touch on it. As we went through 2019, there was a huge amount of momentum behind the effort to address climate change. We saw major commitments at a corporate level, at a state level, at a supranational level with the EU, and at a civil society level to address climate change. So as we entered 2020, it felt like climate change was riding high on the political and corporate agenda. Now, obviously, that all came to a grinding halt with the spread of COVID-19. And that was clearly the more immediate challenge that had to be dealt with. But I think what we've seen over the last few weeks is that the effort to address climate change does not have to be derailed by this. And in fact, the effort to repair economies after COVID-19 and the effort to address climate change can actually go hand in hand together. And we saw that very clearly with the EU's Green Deal, which they came out with back in May, that these things can be both tackled simultaneously. So I think I'm pretty much out of time. So I'd just like to sum up and say that addressing climate change requires a really radical reduction in greenhouse gas emissions. And we need to look at all sources of emissions, both the obvious ones and the less obvious ones. There will be stranded asset risks and other risks as we go through this transition, but there are also huge opportunities for sustainability leaders. And Schroder's is really focused on capturing the whole range of opportunities from this climate transition.
Muchísimas gracias.
Well, thank you very much, Isabella. Thanks a lot for your presentation and your time. We have some questions for you, quite a few questions actually, from the audience. Some of the questions refer to COVID-19, which you mentioned just a few minutes ago. I was thinking about the Australian wildfires that were hitting the headlines and suddenly they disappeared from the press. So what do you think about this momentum? I'm referring both to the regulator and to investors, to the investing community. Do you think they will continue to fight climate change? Will it remain their priority now?
It has been a topic that we've been thinking a lot about. I think certainly when COVID-19 hit, there were some practical ways in which the effort to address climate change was impacted. For example, COP26, which was going to be the UN's flagship climate conference, has had to be postponed. So that's an obvious way in which this has been impacted. And we've also seen some logistical bottlenecks in terms of building renewables. But in terms of the underlying momentum, we've been really encouraged to see that countries are not walking away from their climate pledges. And if anything, we're seeing these green stimulus packages coming out, as we saw in Europe, as I think we'll see shortly in the UK. So we've actually been encouraged by the commitments we've seen recently. But yes, there's been a bit of a practical impact, but I think the longer term structural impact, this is a multi-decade trend. And I don't think it's going to be derailed by the COVID-19 crisis.
Isabella, hay una pregunta, además ahora que nos...
Isabella, there is another question. Considering that the US elections are just around the corner, it's even more relevant, this question. The US administration non-supporting climate change efforts, is it having an impact on US corporate decisions. And I'm asking this question because 38% of your fund is made up of US companies.
It's a really good question. So obviously, President Trump took the US out of the Paris Agreement, which at the face of it seemed like a bit of a blow to the momentum behind addressing climate change in the US. But what we've seen is that at a state level and also at a corporate level, that ambition has remained there over the last 4 years. Companies are still increasingly setting themselves tough targets on reducing their emissions, and we're continuing to see states, not just states like California, but other states also putting themselves on a path that would be consistent with a 2-degree world. Having said that, we've got the election coming up. We know that some of the policies that Joe Biden has been talking about would be very positive for addressing climate change. He's talked about net zero by 2050. He's talked about carbon prices. So let's wait and see. But at the moment, despite President Trump being in office, we have seen quite a lot of momentum at the state and corporate level in the US.
Muchas gracias, Isabella. La verdad es que tenemos muchísimas preguntas y muy poco tiempo, con lo cual voy a intentar.
We have lots of questions, but very little time, so I will try to group some questions together or summarize them. On the one hand, we have a question here. How did the fund manage, how did it fare recently? What was its performance? And I have another question. What could be the main obstacle in this climate change sector? I've analyzed your fund, and the main positions, Amazon, Alphabet, Iberdrola, are consolidated companies which are included in other global funds. What benefits could we find in contemplating your fund in an equity investment versus a global equity fund?
It's a fair question. Obviously, what you can see is our top holdings, which tend to be the bigger stocks because we can have a bigger weighting in those. But there is certainly, within the 66 names that are in the fund, there are lots of much smaller and kind of more pure play ideas. But I think it's important when approaching this strategy to be able to invest across the whole spectrum, because we do find sometimes in the really pure play spaces that the valuations become unattractive, and sometimes the better way to play the theme is within a bigger diversified company, if that makes sense. So I think I take your question, but I think if you saw the whole range of investments, you'd see it's pretty different from a typical global equity fund.
Y la última, para terminar, tenemos muchas más, pero tenemos que elegir, es ¿qué papel debe jugar?
One last question. What is the role of the financial sector from the perspective of innovation and funding innovation in the climate change area? And more specifically, do you have any examples of an example of a company who decided to do something about this after getting in contact with you?
I'm not sure I understand the second part of the question, but on the first part, I think people within the financial sector, we all need to start thinking about the risks and opportunities from this. I think a lot of people, we are managing money for clients. We need to take note of the risks that I think are very real with this transition, not just the stranded asset risk I talked about, but also life becoming increasingly difficult for companies whose business models are not consistent with that 2-degree world. So I think it's a risk management thing, but I think also from our perspective, I think there's sort of exciting opportunities, and if we can get our heads around it, then we can be there to support the companies that are going to be providing the solutions to this problem.
Muy bien, muchísimas gracias, Isabella. Gracias por estar esta tarde con nosotros.
Well, thank you so much, Isabella. Thank you for being with us. We hope you'll have a good afternoon after this. Thank you.
Thanks. Bye.
Muy bien, ahora vamos a pasar a estas dos preguntas que hacemos.
Okay, and now we have 2 questions to get feedback from you on this investment strategy. So the first question is, did you think it was an interesting investment strategy or opportunity that Isabella was talking about from Schroder's? So let's have your votes. finec.com/BIOS. Remember BIOS, all caps. And you'll see the question on the screen. And the countdown starts now.
10 segundos, ya sabéis, si os ha gustado mucho, le dais 5 estrellas, si os ha gustado menos, pues ya vais bajando hasta de 4 hasta 1. Máxima valoración, 5 estrellas, esta presentación que acabamos de conocer sobre la oportunidad de inversión en cambio climático.
It's about what we were just hearing on that investment in climate change strategy. Thank you very much. And now let's talk about the feedback on Isabella's presentation. What did you think about Isabella's presentation? Time to vote. Now. Countdown starting now.
Tenéis para votar. Vamos a pasar ya enseguida a la siguiente presentación. Ahí lo tenéis. Ya sabéis, si os ha gustado 5 estrellas, 1 si no os ha gustado.
So 5 stars if you liked it, 1 if you didn't, and everything in between. Well, thank you very much for that feedback. Thank you very much for the questions. There were so many questions. It's a shame we couldn't answer them all. And now we're going to move to our next speaker. If we're ready, we're going to move now to a different place, and we're going to hear about a very interesting artificial intelligence, a very interesting investment opportunity, artificial intelligence from ODDO.
I'm the lead fund manager of ODDO BHF Artificial Intelligence. I have more than 20 years experience in the capital markets and all my career has been done in technology. I started my career in 1999, so I saw internet coming. I'm based in Paris today, but I have spent 7 years in London. I would like to thank you for taking the time today for this conference on ODDO BHF Artificial Intelligence. I would like also to thank FinTech for having us here today. So today we are going to talk about a global equity fund that invests on artificial intelligence while using artificial intelligence for part of the investment process. In this fund, you are going to find companies from all geographies, all market cap, and all sectors, as long as you find companies that create economic value from artificial intelligence. So why did we launch such a fund? We are convinced that AI is a silent revolution that is going to impact all sectors. And we are also convinced that AI in the next decade is going to deliver trillions of dollars of economic value in the economy. So today, I would like to start by telling you our investment process and our investment objective. Then we will have a review of our performance. We look closely at the liability and the asset of the fund. We will take after that one example of a company in the fund that develops the investment case. So, a quick overview of our investment process, and there are a lot of data on that slide. So basically, it's a global equity fund. So we have a first challenge is to consider an investment universe of 4,600 companies. And to do that, the step one is the step that is going to use machine learning algorithms. So for that, ODDO BHF Asset Management has struck a partnership with one of the leading European data science companies in Europe called Equimetrics. We have 8 data scientists working with us to process 4 million data on Bloomberg. And through algorithm, we use is 70 analysis, sentiment analysis, and trend analysis. And thanks to that step one, we are going to find the best 300 companies out of the 4,600 companies. As you can see in this step one, the idea was to integrate the unstructured data in the investment process. As you know, 80% of the data of the world today are unstructured. So we got the intuition and then the certainty that we needed to include this data unstructured on the investment process. But it's just the step one. Once you have these 300 companies, you have to enter a second step, that is where we introduce the structured data. And here it's a proprietary quantitative model with 4 factors: valuation, quality growth, momentum, and size adjusted from the risk. And from these 300 companies, we are going to select this time the best 60 companies. But it's not finished. Then what we do in the step 3 is that we review each of these companies and we proceed to exclusion. Usually 8 to 10% of companies are excluded in step 3. We exclude companies on the basis of the adequation to the artificial intelligence theme. You can imagine a company that communicates very well and goes through step 1, but finally we realize the analyst, the PM of the fund, that the company does not create enough value from AI, so we exclude. We also exclude companies on ESG factors here. We also exclude companies if we realize the data, the structured data of the quant model that have been used in the quant model are not consistent. Sometimes it can happen on the market that exceptional event can for example, twist the EPS growth or the momentum of the share price. So we restate from that. So these 1 to 3 steps work every quarter. We rebalance the portfolio every quarter, and to proceed to a rotation of 1 time per year. In between each rebalancing, we have a proper management risk by each company. And of course, if a major operational things happen in a company, like fraud, like a major operational risk, of course, we will sell the company. As an example, last year we sold Boeing in the US at $378. It was in March last year, 2 days after the crash of Ethiopian Airlines involving the Boeing A377 MAX. So it is about a process. So what are we trying to achieve here? What we are trying to achieve is we want to beat the benchmark MSCI World every year by the largest possible extent while offering a limited volatility. So we will judge the performance later. But we believe that we will achieve that risk, that goal through one, incorporating the unstructured data on step 1, and I would say fighting against the cognitive bias, the cognitive limitation of a human portfolio manager team, where finally with the step 1 we have more information than if we have 20 buy-side analysts in the planet. Now, my experience has been that you can know as an analyst 120 companies in the world. Here we process 4,600. The step 2 is very important as well to find this time against the psychological bias. Fear, greed, or various emotions in difficult markets that would push you or lead you to intervene on your portfolio, while in reality you should stick to your gun. And the step 3, of course, is very important. So the PM 2.0, even if he uses, I would say, very modern tool, the human is everywhere. Human is in step 3. Human is in step 2 to build the quant model with the quant guide and to check the data. And human is in step 1, because in step 1, as a PM, you are the guarantee of the investment thesis. Keywords are finding companies in step 1. Algorithm, it takes to translate them in score, and you have to make sure that you have the right words to find the most innovative company. And by the way, our keywords are changing every 6 months, so that on a scheme like artificial intelligence to capture the latest innovation. The fund was launched 18 months ago. So since 18 months, we have outperformed our benchmark MSCI World by more than 13%. Year to date, we have outperformed the benchmark by more than 7.5%, and we are slightly positive as of today. But maybe the most important things to me is the steadiness of that performance. June is going to be the 9th month in a row of outperformance. What is also important for me is the quality of the performance. The information ratio of the fund since inception is 1, and over the past 12 months, the information ratio is close to 2. Actually, as I told you, we have 7.6% outperformance with the tracking error around 4. So as you see, there is a quant approach all over the fund, and many formulas have been backtested to optimize the quality of the performance, to optimize the couple between volatility and performance. And I think this is important. Now moving to a quick overview of the asset of the fund. So first of all, there are 60 equal weight positions in the fund. As you can see, there are 12 different sectors, but in reality, we have 2 big sectors, technology and healthcare as of today. The process is pretty nimble because early Jan last year, in 19, we had 3% of healthcare. So in the course of 19, we have gradually increased the exposure. And I remember that in September last year, we made massive move on healthcare 6 months before a major sanitary crisis. Technology has always been constant. But what you can see on the sector is we have a quality growth and low-vol positioning. And we stick to that. Even in May, when there was a major, that last 1 month, a major sector rotation to more cyclical, we stick to this gun with our process and not with human intervention, with our process. And it has proven to be, as of today, the good decision. By geographies, it has always been the case that we have 2/3 in North America. What has changed lately, I would say since early June, is that we have only 10% Europe now, minimum, and we have increased the exposure to Asia, out of which China is 8%. And I would say this move is much more consistent with the theme of artificial intelligence. By market cap, what makes us unique in that fund is that, as you know, today 5 stocks are representing 20% of the US equity market: Google, Facebook, Amazon, Apple, and Microsoft. And we are underweight on these 5 stocks, to be clear. All combined, these 5 stocks will be around 6% of the fund. And as a result, thanks to the machine learning algorithm, to the accuracy of the tool, we find golden nuggets of AI that are very deep in some sectors. Like, for example, in semiconductor, we can find the only company that is doing only one step of the investment process of building a chip, which is form factor. We have 2 companies in the world that are making the test of the chip, and it is a market that is going much, much faster than the semiconductor itself market that is stable. In software, it's the same. You can find very small companies everywhere. In medtech, you will see my example later. We have a very small company that is fully benefiting today from what's going on in the COVID crisis and with the rise of fast new pay. There is a trade war between China and US. There is one company winning in the world. It's a Taiwanese company, MediaTek. This is a company that our process made us buy. Something that makes us different on top of being overweight on this FANG stock and underweight on FANG and overweight on small cap. We also do not invest in loss-making companies. Let me give you an example. Netflix, Tesla, they are companies fully in the artificial intelligence theme. They are selected in the step 1 in the top 300. But they have never been in the fund because the step 2, with a quant approach, we don't invest in loss-making companies. A ratio does not like losses, basically. The third thing that makes us different is that, as you can see on the price earnings of the fund, we have been constantly since inception in line or slightly below the price earnings of the benchmark MSCI World. That means that not only we expose you to a fast-growing thematic, but we do not buy companies with exuberant valuation. And today there are a lot of companies with exuberant valuation. We just have one company out of 60 that is trading at more than 20 times sales. It's not a lot. And also the quality of the balance sheet of the companies, of these 60 companies, matters for us. We have 50 companies, 50% of companies, so basically 30 companies that are net cash position. And we have only one company with net debt to EBITDA above 4. Also, it pertains to our approach. In terms of assets, the fund today has reached 100 million euro, which is $114, as you can see on the chart. Year to date, we have collected more than 40 million. What I can tell you on that, I think two things. The group ODDO BHF is invested in the fund, showing alignment of interest, and the investment team, the management team, is also invested significantly in the fund, showing that we believe in what we do. I think the reason why we have collected in a difficult context since the beginning of the year is because the thematic of artificial intelligence is uppermost in everybody's mind, like something you should be invested in for the secular growth of the next decades. Also because it's a quite self-explanatory thematic, but also because of the steadiness of the performance. 9 months in a row of outperformance. Some fund selector told me 6 months ago we want to see the fund in a very stress test. So they saw the stress test from end of February to end of March, and during that period the fund outperformed by more than 300 bips. So actually one of the points of differentiation of that fund also is that it tends to create more outperformance in very difficult conditions than in very favorable conditions. That because of the diversification, because of the C-stock single weight, we lag in upward phases, but we outperform also in declining phases. One example of a company in the fund, one of these 60, we have for more than 1 year these companies. So it's Massimo. Massimo is a US medtech company, and it's a small cap. As you can see on the step 1, we have selected Massimo thanks to algorithm. Massimo was screening very well with keywords like signal processing, monitoring sensors, but the company was not so much well run. She was 260, but she was selected. The sentiment score was average, but as long as she was in the best 300, she came. But then on the quant model in step 2, the company was super strong because you can see on quality growth, size adjusted on the risk and momentum, the company was doing very well. Of course, the company was not so valuable because before we bought that company, the stock has been multiplied by 6 over 5 years. It was a real compounder, a company with high return on capital employed, on a niche market with few competition. Exactly the kind of golden nugget we want to find. And year to date, I think the company is up around 50%. It's one of our best performers. What are they doing? But they are doing basically patient monitoring and non-invasive pulse oximetry and so many other measurements on the human body. So basically you have the image of ICU bed and you have this patient monitoring next to the ICU bed and with this sensor. And of course it's working with AI and big data to be non-invasive and measuring a lot of data from the human body. So the key number of that company is that this quarter in Q2, they are going to sell 150,000 patient monitoring systems, which is X.2.5 what they used to sell in a normal quarter. So this company is fully benefiting from the COVID-19 effect, from the countries like North America, Italy, France being obliged to invest massively in ICU beds because we didn't have enough of these beds. Of course, this is going to last for 5 or 6 quarters. We have to reflect that, and not more. But it has been for more than 1 year. We didn't buy the company at the time of COVID. We were older before. It was a nice story. And I think it's a good epitome of what I wanted to tell you. Each time we find company on niche market, on sector, this is what we want to do. So I would like to conclude by telling you that why you should consider this fund for your allocation and the dynamic part of your allocation. Because I believe it's a unique product in the market, using the most modern tool available for an asset manager. You have machine learning algorithms, you have multi-factor quant model with 10 years track record of beating the market, and you have a super experienced management team that is reviewing everything that should be reviewing the process. The second reason is a conviction on a thematic that is artificial intelligence, for which we are just in the early innings, and it is going to deliver trillions of dollars. And the third thing is, I believe, over 18 months of real life, we had 10 months backtest, but we have shown that we outperform in very different market conditions with steadiness and with a limited volatility. I would like to thank you for listening to me today.
Muchas gracias a ti, Brice, por tu presentación.
Thank you very much, Brice, for sharing this investment strategy and thematic surrounding artificial intelligence with us. And we have a question which is often in the media. When people talk about the opportunities for artificial intelligence, they also talk about the risks to privacy, for example. And there's a question that says here, how can you reconcile artificial intelligence with ethical and moral questions like privacy or population control or surveillance? Could these impact the valuation of the companies in your fund?
It's a fair point, and it's I would say it's a very up-to-date question with what's going on today with Facebook, for example, and I would say the controversies with big clients like Verizon or Coca-Cola that are retrieving for Facebook. And it's true that when you see the valuation of Facebook today and you compare their earnings multiple with their EPS growth, without these controversies, that the valuation of Facebook would be much higher than what it is today, to be honest, because Facebook looks cheap if you do take into it. So I think market knows that. That's a fair point. I want to give you another example in China, and I can be very transparent with you. We are invested in the most emblematic AI Chinese company called Deep Vision, and they are doing basically the camera of video surveillance with a US semiconductor, by the way. And so this is a bit the dark side of the Chinese society. So it's a fair point to say that when you invest in artificial intelligence, you have to be cognizant of what that can imply, even if we are just in the early innings.
And then there's another question that's very interesting too, which says, why is there so much scatter in the results of funds that specialize a bit more in artificial intelligence when most of the broader technology funds seem to have a more similar performance?
I'm not sure I get quite well the question. Could you reformulate the question, please?
Sí, dice...
Yes, it says that funds that specialize in AI tend to have a bigger scatter in their return. They seem to have very diverse returns more than the broader technology funds. Why is that?
Let me explain you the backdrop. What has happened? I have spent the past 20 years on capital market on technology. You have to be aware that what has happened this year in technology happens once every 20 years. The last time we had similar things was at the internet bubble back in Q1 2000. These both periods are periods where we believe that technology is going to change everything. You know, during COVID-19, Satya Nadella, CEO of Microsoft, was saying in the course of 2 months of lockdown, we had 2 years of digitalization. And it's true that e-commerce has picked up 45% year-over-year growth instead of 10%. This is fair. But at the same time, with distance on that, we all know that it's exaggerated. As a result, of that situation, of that backdrop, what has happened in H1 is that the 100% global tech fund investing just of technology have performed very well, while the more thematic fund like us with only 50% of technology, the other 50 being on sectors beneficiary from AI, have been more balanced. But believe me, with my experience, after such a period of dislocation between technology and the rest of the economy, there will be a mid-reduction, there will be a reversal. It's automatic. I'm fully comfortable to say that technology and digital is a long-term trend, but not always with the same magnitude. So I believe our approach is more sustainable and less risky, because when you invest massively, you remember what I said on the valuation of technology, we have one company out of 60 at 20 times sales. Take some distance about what's going on today. Zoom Communication is trading at 15 times sales, 50. It is more than 7 big airlines aggregated. So it should be a signal that a balanced approach can be needed.
Y la última para...
Okay, and the final question to finish, Brice, they're asking, do you also consider things connected with Bitcoin, for example, companies in Bitcoin or in smart contracts, for instance, when allocating?
We do not have a direct exposure to Bitcoins, but we have indirect exposure to Bitcoins. When we are invested in Taiwan, in TSMC, which is the leading fab of semiconductor of the world, 50% of the chip of the world goes through TSMC. At some point, when the Bitcoin price is very high, you have a lot of engineers with GPU mining Bitcoins, and sometimes TSMC revenue can be derived because we have on Bitcoins. We are not directly on Bitcoins.
Thank you very much, Brice. It's been a pleasure to hear your views on AI and how it helps you even select the companies with keywords, natural language recognition. Very interesting. Thank you so much for your time, Brice.
I appreciate.
Gracias.
Thank you also to those of you who are sending in questions. Finet.com/BIOS, BIOS caps. Now let's move to the final survey after this presentation to see what you think. First of the investment strategy. So let's start with a survey. Countdown starts now.
Ya sabéis, ahí está ya el tiempo de votación. ¿Qué os ha parecido esta idea de inversión?
What did you think about this investment strategy from Brice, ahora BHF? 5 if you really liked it, and 1 if you didn't like it so much, and everything in between. And now we're going to see the results, and we're going to move on to the second question, in which we're going to ask you your opinion on the presentation, on Brice's presentation. What do you think of his presentation?
Vamos a ver, ahí tenemos, ahí está el tiempo para votar, ya sabéis, 10 segundos. Antes de pasar a nuestra última idea de inversión de la tarde, nuestra última conferencia, muchísimas gracias por vuestra participación. Os recuerdo en el...
Well, thanks a lot for your participation. Once again, remember that in the BIOS group, as the presentations are made, we upload the PDF for you to follow the presentation in your screen. So you can download the PDF presentation to see it as the speaker presents it. And in the app you're using, you'll find the link to download the presentation. So thank you very much for your feedback, for your participation. And the last presentation is about to start. Morgan Stanley has been a global leader in financial services for more than 80 years. We are a leading asset manager, both in public and in private markets and sectors. We have a global presence. That's why we have local knowledge and with services tailored to our customers' need. Our approach takes our customers' needs into account. Morgan Stanley Asset Management can provide a unique support for our customers to reach their long-term investment goals and also to cater for changing and unique investors' needs around the world. And this first session of BIOS 2020 ends in Cromwell, where Alistair Corden-Lloyd goes to find the better waves to surf. He has a solid experience in investing in high-quality brands and high-quality companies.
Well, thank you very much, everybody, for having me and also for staying the course after what must have been a long day for you. I'm going to spend the next 20 minutes discussing how we invest in high-quality companies and why we invest in quality companies. We've been doing it for 24 years now, and it's provided good capital growth, companies with strong earnings visibility, and importantly, providing reduced downside participation. Now, what we're looking for in our high quality companies is, I'm just trying to get is that what we found in the last 24 years is if you invest in very high quality companies that are able to sustain the high returns on the capital they have from their intangible assets like brands or networks, that's a strong route to long-term attractive returns. They need to be well run by capable management, management who can allocate capital really effectively to help develop their franchises. These are high quality companies with powerful balance sheets that generate a lot of free cash flow. So management has a lot of degrees of freedom to spend that money, so they have to be good at it. We have to be able to buy these very high quality companies at a reasonable price. And I'll show you at the end of the presentation that that's true. And as I said, we've been doing this for a very long time, for nearly a quarter of a century. What we're really after are companies that have the ability to compound, and it's the high quality companies that can do this. If we look at our Global Brands Fund, for example, you can see that this century it's produced 3 times the return of the broader index by compounding at a higher rate. So how do we find companies that have that ability to compound? Well, one thing that I've mentioned that is crucial is that they don't let you down when the broader market does. So you can see in this slide that I'm showing you now, across this century so far, there have been a number of difficult years in the market. In every single negative year that our high quality company portfolios have faced, they've outperformed the broader market because the market rewards high quality, it rewards earnings visibility, it rewards strong balance sheets and good management teams. One of the key components of the successful compounding is the downside capture. So this strategy of ours and all our global strategies have an asymmetric pattern of performance. That means they get most of the upside of rising markets, but they only participate in half of the downside. So if you're getting most of the upside and only half of the downside, mathematically you will outperform over the long term. And we do it at lower volatility because these are the companies that are very, very steady growers. They're steady compounders. So compared to a number of different opportunity sets, like the quality index, for example, or the S&P 500 or the FTSE All-Share, superior return, a better return at lower volatility. And one of the reasons for that is that the brands and networks that our companies have typically interact with us, the consumers, on a daily basis, and that gives you a recurring revenue stream. When you wake up, you interact with brands to make an effort to be presentable. When you go to the office or even now at home, you log into a computer system, you need networks to be able to allow you to work on a daily basis. You interact with brands when you eat. You interact with brands when you clean your house or clean the office. You interact with brands and experiences and networks in the evening when you relax. You go to bed, you get up again, and you do this all over again. Irrespective of whether we're in a down market or an up market, this repeat pattern purchase continues through the cycle, and that gives you very powerful underlying economics. More specifically, what's our definition of a high quality company? Well, this very simple chart is a good tool to show you how we think about quality. As I've mentioned, we look for companies with a powerful intangible asset, like a brand or a network. We don't own companies that generate their economics because they own big physical assets. Good examples would be mining companies, materials companies, utility companies, telecoms companies. They need big physical assets to generate their revenues. We look for the intangible assets. And one of the advantages of intangible assets is they typically have pricing power. The brands and the networks have pricing power. And we see pricing power. What metric do we look for? It's a high gross margin. And there is a good relationship between how high your gross margin is and how stable it is. So if you buy high gross margin businesses, you're typically buying stable businesses. The next thing, the advantage of looking for companies that are driven by their intangible assets and the fact they don't need big physical assets is that they're then going to have a high return on a small asset base. So high gross margins, limited capital, high return on that capital. The next advantage is if you don't have much capital, you don't need to spend much of your profits, of your cash flow, maintaining that capital. So therefore, our companies typically produce more and more stable free cash flow than your average company. The conversion rate of your earnings into free cash flow, and free cash flow is the money you genuinely can spend and allocate, is around 94%. It's more like 78 to 80% for the broader market. So you're getting more cash flow in a more stable way to reinvest in the business to help maintain those gross margins and develop those brands. Quite a simple approach. However, the inconvenient truth is clearly not all companies can subscribe to that definition of quality. So our quality strategies are concentrated by virtue of not having very many high quality companies to choose from, but also where we tend to find them. And where we tend to find them is in the software and services part of information technology. We don't own semiconductors, we don't own hardware because they're cyclical, they don't have the steady profile we're looking for. In healthcare, while we acknowledge that pharmaceuticals are relatively stable in down markets, because we have a very long-term investment horizon, we tend to steer away from pharmaceuticals because we don't want to take the risk of patent expiry. Drugs under patent are the most profitable. If you lose the patent, you run the risk of losing a significant amount of your profits. So where we tend to find high quality is in the life sciences and the healthcare technology. And then in consumer staples, which is the largest part of the Global Brands Fund, for example, not all consumer staples are high quality compounders. So we don't own food retail, which is capital intensive and low margin. And we also find fewer opportunities nowadays in food manufacturing because what we've experienced there is a lack of pricing power. It's getting harder to maintain pricing power. Where we tend to find good opportunities is in beauty, for example, like L'Oreal, in spirits. There are one or two other parts. So the 20% that is not in those three, we find some unique opportunities in credit scorers, for example. We had found some opportunity in branded content media, but that's largely gone because of M&A. Just in terms of being current and relevant, it's also true that those three key sectors are the sectors that have proved to be most resilient in downturns. So if you take the credit crisis as one of the most recent significant earnings downturns we've experienced, you can see from this slide that healthcare, consumer staples, and IT software and services have the most resilient set of earnings. They hardly moved in the credit crisis, whereas the broader market's earnings fell 40%. I mean, that's significant. And even in Q1 this year, the dislocation because of the containment of the coronavirus, you can see again, these three are relatively the strongest in terms of price performance. Our exposure has evolved over time because things change. Our philosophy doesn't change, our process doesn't change, but our opportunity set can change. And what you can see from this slide is a significant increase in information technology through software and services, because effectively the cloud has created a subscription annuity stream for the likes of Microsoft or SAP. And we've also had more opportunity in healthcare technology and life sciences, largely driven by M&A because the pharmaceutical companies have been offloading, they've been IPOing their crown jewels, the likes of Danaher and Abbott, for example. In terms of our exposure from a revenue perspective, if you look at the right-hand side, you can see that the economics of our portfolio come from North America principally, and also a large part of the emerging market consumer, which has a very, very strong structural tailwinds because of the rising middle class and the significant demographic. Just to give you an example, you probably didn't know, but how many babies are born in India every month? 2.2 million. So if you're in baby food, not a bad place to be. I mentioned right at the start that one of our key disciplines is valuation. Can we provide you with a very high quality equity strategy at a reasonable price? And I think this chart to a degree helps you with that. You can see on the right-hand side that yes, on a price to earnings measure, which is the common currency in markets, there is a premium to be paid. There always has been. But we don't value our companies on earnings, we value them on cash flows. And you can see that the spread, the difference on the price to free cash flow measure, the price to actual money the companies make, is much more narrow. So you're paying a very small premium for a return on capital that's nearly 4 times the average company, gross margins that are twice the average company, much less capital intensity, and strong balance sheets. So that's a very quick overview of how we think about quality and why we've demonstrated that it works over the long term for long-term investors. So back to you in the chair.
So I have some questions for you, Alistair. The first question, in terms of valuations, Alistair, these companies have stable revenue streams, recurring revenue streams, but does that mean that the prices or their valuation ratios are higher or not?
Good question. Do you have to pay more for quality companies? As I've just mentioned, on a cash flow basis, on the real money that the companies make, you pay a very small premium in the margin of error. So you pay 20 times for a high quality company and 19 times for an average company. So paying that little bit more for significantly greater security in the fundamentals that company produces, I think is an extremely modest premium, particularly in an environment that is really quite unsure and uncertain.
¿Cómo integráis en vuestra...
How do you go about integrating? How do you incorporate in your portfolio ESG factors?
Important. As I said, we've been running high quality companies for 24 years, and one of the key components that we look for is capable high quality management. So governance has been central to our investment process and philosophy for a quarter of a century. Increasingly, environmental and social factors are also important. So we integrate ESG at the very beginning of our investment process, and we're looking for material risk and opportunity. One of the advantages, global brands and global sustain, for example, have only 6% of the carbon footprint of the index. So it's one of the lowest carbon footprints in an equity strategy that you can find, plus you're getting very, very high quality companies.
There is another question. In today's time, of course, people are investing more and more in the health sector. Aren't you considering the possibility of investing in the pharma sector, even if it's not part of your philosophy? Pharmaceutical companies.
We wouldn't invest in anything that doesn't fit our philosophy. That wouldn't make sense. We will keep away from pharmaceuticals. We have owned some in the past that are very diversified, so you're taking very, very little patent expiry risk, but we don't have those opportunities just now. So really where we find the opportunities is in the life sciences and healthcare technology space, where also, interestingly, you're not taking as much political risk with all the difficulties around pharmaceutical pricing, particularly in the United States.
Hay una pregunta interesante, hay varias...
We have an interesting question here. You've mentioned several companies, Magnum. I mean, there was something related to Magnum, to ice cream, right? ice cream, Magnum ice cream, new regulatory trends in terms of sugar content, would they have an impact on those companies? I mean, these are consolidated companies, mass consumer companies, whose products perhaps are not very healthy as the new food products that are succeeding now.
That's a very good question. And as I mentioned, ESG can be a risk and an opportunity. It's a significant opportunity for our companies if they can produce products with a purpose. So whether it's Coca-Cola moving to sugar-free or moving to more natural ingredients, even in ice cream, or less sugar in ice cream, less sugar in yogurt, and we've gone through the less fat, we're moving into less sugar. These are opportunities to differentiate yourself from your competition if you can do it successfully. And the proportion of brands with a purpose, products with a purpose, which is actually very much Unilever's strapline, is increasing all the time, because what you have to do to be a successful compounder is remain relevant to your constituency in all age groups, whether it's millennials or older people or middle-aged people. It's very, very important to address their concerns and needs and to have the information and the flexibility to be able to produce product to meet them. And it's the large companies that are in a very strong position to be able to do that. So a very good question. We see it as an opportunity, and where our companies see that they might have legacy product, they're switching those products to become relevant to their consumer base, whether it's through the packaging or the actual product.
Interesante. Buena parte de las compañías.
That was very interesting. Most high-quality companies are U.S. companies. So the U.S. market has consistently outperformed other geographies. Will this trend continue, or could it change? Perhaps could that be a risk of those companies not performing so well in the future?
There are two risks that you take when you invest in principle. One is that the earnings that you thought you might have invested in go away. They're not as reliable as you thought. And the other risk is that you paid the wrong price for those earnings, and the multiple, the ratio, goes away. So if you are disciplined and you pay a reasonable price for earnings that are durable, reliable, and resilient, you're not taking the risk. It's not really a country-based issue. However, what I would qualify is, yes, the Americans are very good at enterprise-wide software, and they're very good at healthcare technology. The Europeans are very, very good brand builders. So that is why you see a lot of consumer staples coming out of the European cohort globally, and a lot of the technology coming out of the US. So it really depends. We don't really care where the company comes from, as long as it has the right criteria to meet our very high standards to get into the portfolio.
Y la última, Alistair, una de las...
And this is the last question. I mean, their potential, the growth of the emerging middle class speaks a lot in favor of these investments. I mean, an increasing number of consumers in India, China, and elsewhere. But what could happen? I'm referring to the geopolitical situation. If globalization is halted, if everything becomes more local, and that could have a huge impact on those investments, right?
Yes, good question. And one of the concerns that the business community is facing is an increase in deglobalization. And what does that mean? It means that there's a risk to the cost of your supply chain. You're going to have to become more local. And that could mean you might have to run higher working capital, which is relatively more expensive in terms of your cash generation. One of the advantages of a high quality strategy is clearly a supply chain for a software company is very, very short, because it's through the ether. It's not through factories that you have to relocate. In consumer staples, they have always had a very short supply chain anyway. So they tend to assemble and finish goods very close to the point of sale. So they're going to be far less disrupted if that is an effect of deglobalization. And then healthcare too, again, is typically assembly, if it's required, for, I don't know, syringes or saline bags, relatively close to that hospital environment. So we don't see with our companies a particular risk in the dislocation of the supply chain. And that's quite an important consideration. For other companies, it could be a margin risk because you're going to have to increase your costs to have your supply created nearer the point of sale, and it's going to increase your inventories and your payments, so that's going to have an effect on your cash flow statement. So it's a very, very good question, but high-quality companies like ours are less, they're not completely unexposed, but they are less exposed than your average company because of their profile.
Te había dicho que era la última, pero acaba justo de entrar una.
Well, it wasn't actually the last question. We've just received another question. Morgan Stanley Global Brands and Stanley Global Sustain. What kind of investors are they recommended to, and what are the main differences?
Between Global Sustain and Global Brands is age for a start. Global Sustain was launched last year. It has exactly the same high quality investment philosophy. It's even the same investment meeting that we all sit around the table for. But Global Sustain gives clients who want the opportunity for access to a very high quality portfolio, but they don't want to own controversial industries in their view, like alcohol or tobacco, then Global Sustain is for you. That's the principal difference.
Bien, muchísimas gracias.
Well, thank you very much, Alistair, for your time. It was a pleasure to welcome you.
Pues terminamos. Antes de irnos, vamos a hacer por favor esta preguntas.
Okay, so we're going to finish. Let's just do these feedback questions before we go. The first one is, what did you think of this investment strategy that Alistair talked about from Morgan Stanley, this global brands strategy? Countdown starts now. Remember, there's 10 seconds, and tomorrow, after the session tomorrow, the second day of BIOS 2020, we'll post a link with a test for those of you who are ESTA members, so you can get those credits for your recertification. And now let's move on to the second question about Alistair's paper. In this case, what did you think of his presentation, of his talk? Time to vote starts now.
Tenemos esos 10 segundos, ya sabéis.
So again, you have 10 seconds. If you really enjoyed the presentation, a 5. And if you didn't like it quite so much, a 1.
Muchísimas gracias por vuestro tiempo.
Well, thank you very much for your time. And for our own feedback, just one final question. Remember, it's same website, fintech.com/bios. And the question is, what did you think of this webinar today, the whole thing? So countdown starts now.
Vamos a ver, aquí lo que os pedimos es, efectivamente.
And here we're asking you, what did you think? Did you think it was really interesting? Did you find it useful from the point of view of investors or advisors? Did you think it was too long? Give us some feedback so we can know what you thought. And if you hated it, tell us that too, so we can improve. So that's it. End of the countdown. Thank you very much to all the managers who've joined us today. And remember that tomorrow we're going to have another session at 4:30. We're going to hear another 4 very interesting speakers. Today they joined us from London and Paris and Cornwall. Tomorrow we'll be hearing people from New York, San Francisco, London. So don't miss it, because I think it's going to be really interesting. And we'll see you tomorrow at 4:30 for our second day of this BIOS 2020. Thank you.